All right, let's dive into some pretty huge news from the financial world. Moody's just dropped their Q3 2025 earnings, and honestly, the numbers show a company that isn't just doing well, it's absolutely firing on all cylinders.
So let's just cut right to the chase with the headline number. For the very first time ever, Moody's didn't just inch past the milestone, they completely smashed through the $2 billion mark in quarterly revenue. That is a massive, massive deal for them.
And let's be clear, this isn't just another good quarter we're talking about. This is a historic high. We are looking at the single biggest, most profitable quarter in the entire history of the company.
The CEO, Rob Fauber, really said it best. He said the power of the Moody's franchise was on full display. And he mentioned significant operating leverage, which, is really just a fancy way of saying they made a whole lot more money without having to spend much more.
So how in the world did they pull this off? What was the engine that powered this incredible quarter? Let's get into the numbers.
The top-line figures here are, well, they're pretty staggering. Revenue shot up 11% from last year. Their adjusted operating margin, which is a great way to see how efficient a company is, swelled to almost 53%. But the real showstopper? Adjusted earnings per share leaped by 22%. I mean, in this economy, that kind of growth is just explosive.
Now, to really wrap your head around that kind of growth, you gotta understand the business itself. Think of Moody's as being powered by two totally distinct but really complementary engines.
So on one side, you've got the raters. This is the Moody's everyone knows, Moody's Investor Service, or MIS. They're the ones rating the risk on debt from companies and even governments. Then on the other side, you've got the data sellers. That's Moody's Analytics, or MA. And they sell all this incredibly sophisticated data and software that helps banks and funds manage their own risk.
And right here you can see how both of those engines were just humming along this quarter. The ratings business, MIS, and the analytics side, MA, both grew big time compared to last year. And put them together, that's what pushed the total revenue right over that historic $2 billion line.
Okay, so let's pop the hood on these two engines. What exactly was it that drove the growth in each of these parts of the business?
For the ratings business, a huge piece of the puzzle comes down to one thing: leveraged loans. This is higher risk, higher yield debt, and the amount of it being issued just skyrocketed by 58%. That provided a huge boost to their revenue.
Now, let's switch over to that other engine, Moody's Analytics. And the secret to its success is staring us right in the face. A whopping 96% of its revenue is recurring. This isn't about chasing one-off sales. Nope. It's all about stable, predictable money coming in from subscriptions and contracts. That right there is the bedrock of the whole division.
The key metric they use for this is called annualized recurring revenue, or ARR. The easiest way to think about it, it's just like your Netflix subscription. It's the total annual value of all of their ongoing contracts, and it gives them this crystal clear picture of the money they know is coming in.
And here's the kicker. That predictable base isn't just sitting there. It's growing. Their total ARR just hit $3.4 billion, which is up a very healthy 8% from a year ago. That creates an unbelievably strong foundation to build on.
Okay, so record revenue is one thing, but that's really only half the story. The other part of the equation, which is just as important, is how good were they at turning all that money into actual profit? Well, it turns out they were remarkably good at it.
And this chart right here shows you how they did it. Just look at their operating expenses last year versus this year. They're practically flat. So while their revenue was soaring up by 11%, the company kept an iron grip on its spending. Now that is the operating leverage the CEO was talking about.
And here's the direct result of that amazing cost control. When your revenue goes way up, but your costs basically stay the same, what happens? Your profitability just explodes. Their adjusted operating margin jumped by more than 5 full percentage points, all the way to nearly 53%. That's just a massive leap.
So, a record quarter is officially in the history books. Great. But what does Moody's see coming up on the horizon? Well, their latest forecast shows they're not just feeling good, they're actually raising their own expectations.
The company's CFO, Nomi Wayland, she put it pretty bluntly. She said they expect this momentum to keep going. They're boosting their guidance for the full year, and now they're projecting an incredible 17% growth in earnings.
This table really spells out just how much more bullish they've become. They've bumped up their targets for revenue growth, for earnings per share, and for their profit margin. But look, pay close attention to that very last line.
By raising their own forecast for U.S. GDP growth, they're sending a signal that's bigger than just their own company. It's kind of like a vote of confidence in the entire U.S. economy.
And that really brings us to the big question here. Moody's is clearly on a roll, and they're betting that the good times will continue. So what does it all mean? Is this just the story of one incredible company that is executing its game plan flawlessly? Or is this maybe a sign, a little canary in the coal mine, telling us that the broader global economy is a lot tougher and more resilient than anyone thought? Something to chew on.